Here we're looking at a summary income statement for shirts that fit. An income statement is a report that shows how much revenue a company earns over a specific time period, usually for a year or some portion of a year. In other words, it is really a summary of a company's operational performance. It's showing how much money the operations of a business either makes or loses during a specific time period, or what we also call as an accounting period. I'm going to go ahead and zoom in here and we're going to walk through the major lines of the income statement. I'm going to come up here. Now at the top of an income statement is where a company's revenues or net revenues are shown. This shows how much revenue company earned over a specific time period. In this case, over year one. As we move down, think of the income statement as a set of stairs where we start to subtract major expenses from the revenues to arrive at the profit number. So the first main line item is what we call cost of goods sold. Cost of goods sold are the costs directly attributed to producing a product or service. The number tells you the amount of money the company spent they spent directly producing the goods or services it sold during this accounting period. When you subtract the cost of goods sold from net revenues, we arrive at the number which we call the gross profit number. So this shows how much money the company made after subtracting out the direct expenses directly related to producing that product or service. The next section deals with operating expenses. Operating expenses are those that go towards supporting a company's operations for a given period. For example, this could be salaries of administrative personnel or costs of researching new products. Marketing expenses are another example that are a part of operating expenses. This section is different than the cost of sales or cost of goods sold that were deducted above because operating expenses cannot be linked directly to the production of a product or service being sold. So once we subtract the operating expense, we arrive at what we call the operating income line, or in the literature also referred to as the EBIT line. This is earning before interest and taxes. This is a good proxy for the amount of cash flow or how profitable a company's core operations are. As we move down, we have this line that you see, depreciation and amortization. These are what we call non-cash expenses. Depreciation takes into account the wear and tear on assets such as machinery, tools, and furniture, which are used over a long period of time. The way that accounting works, companies actually spread the costs of these assets, so furniture, tools, buildings, real estate, over a period of time which they are used. This process is in effect called depreciation. And the charge for using these assets are actually added back each accounting period, so company owners and investors have a good idea of what the amount of cash a company is producing over the time period. So as you can see down here, we have the line that is called EBITDA. This is a very common term used in the industry and for investors. EBITDA adds back the depreciation and amortization charge because in a sense it's a non-cash charge, so it actually it does not affect the cash flow, but in an accounting sense, it shows that it does affect the cash flow. So what we do is we actually extrapolate out the depreciation and amortization to understand, okay, what really is the true cash number being produced by the company during this time period? So as you can see, we have the EBITDA number right here. As we move down the income statement, we come to the interest income / expense line. Interest income is the money companies make from keeping their cash in interest-bearing savings accounts. Money market funds and similar type investments. On the other hand, an interest expense is the money companies pay in interest for money they borrow. So for this accounting period, this shows the amount of interest shirts that fit paid on any type of loan the company has taken out. After subtracting out the interest income expense line, we come to the earnings before tax. One more step is we subtract the income tax expense for the company, and then we arrive at what we call net income. Net income is the amount of profit or loss that a company produces over a specific time period.